What if I told you there's a beaten-down EV stock that just quietly banked a $100 million windfall out of thin air, got upgraded to strong buy by Wall Street, and still trades for under $5 a share? And what if the entire market is so obsessed with one scary headline that they're completely missing the setup forming right underneath their noses? Welcome back, investors. Today we're pulling apart NIO, and specifically why analysts across Wall Street are suddenly raising their expectations on a company that most retail traders had already written off. Over the past couple of weeks, NIO's stock and its underlying fundamentals have been locked in a brutal tug-of-war between explosive yearly growth on one side and short-term market fear on the other. But beneath the surface of those scary headlines, something is happening. NIO is quietly becoming what I call a spring-loaded asset. 14 days ago, we made some very bold predictions about a massive catalyst window opening up for this stock. Today, we're going to grade those predictions, unpack exactly what happened, figure out where this stock goes next, and answer the big question: is this the ultimate buying opportunity of the year or a value trap in disguise? Before we dive in, if you find this kind of deep, data-driven breakdown useful, do me one quick favor and tap that like button and subscribe. It genuinely helps the channel, and it takes you about 1 second. Okay, let's get into it. To understand why this stock is coiled up like a spring right now, we have to look at the three fundamental pillars holding it together. Because this isn't a story about one catalyst. It's a story about three separate forces colliding at the exact same time. The first pillar is what I'm calling hidden assets. These are windfalls and AI silicon holdings that completely redefine NIO's valuation beyond the traditional EV metrics everyone keeps using. The second pillar is the fundamentals. That means surging Wall Street upgrades and unstoppable year-over-year delivery growth that together form a concrete floor under the share price. And the third pillar is the technicals, a tightly coiled options chain and a short squeeze setup that we are going to break down piece by piece. Now here's the thing. While these growth numbers look incredible on the surface, there is one hidden metric buried later in this video that changes absolutely everything for the short sellers. Keep watching, because when you see it, you won't look at this chart the same way again. So to see exactly how these three forces are colliding in real time, let's start by grading the exact predictions we made 14 days ago. And honestly, it's time for a quick victory lap. In our last analysis, we mapped out the precise fundamental and technical crossroads NIO was facing. We predicted that Wall Street was entirely ignoring NIO's hidden assets. And exactly on cue, the CXMT IPO exploded, surging over 466% on debut, and validating our thesis right alongside a massive bullish note from Morgan Stanley. Then we called out that smart money would quietly accumulate shares at the bottom while retail panicked. And that was perfectly confirmed by SEC 13F filings showing Renaissance Technologies, one of the most legendary quant funds on the planet, scooping up nearly 6 million shares right before this turnaround began. Two big predictions, two direct hits. But the third one is where it gets really interesting. Now let's zoom in on the actual price action, because what the options traders did here is nothing short of a masterclass in market psychology. We previously identified that options traders had this stock locked in a tight stasis cage, pinned between $4.50 and $5 flat. So did it hold? Looking at the actual trading data for the target week, NIO traded completely within that exact window. It hit a low of $4.60, peaked at $4.94, and closed the week right where we modeled it, between $4.84 and $4.88. Think about how precise that is. This proves that institutional traders currently have firm technical control over this asset, and for us that establishes a highly reliable entry floor. But keeping a stock artificially pinned is impossible unless there's a fundamental anchor holding it up from underneath. And that brings us to the single most ignored part of NIO's entire business. When most retail investors look at NIO, they only see the tip of the iceberg, a cash-burning EV maker fighting for survival in a brutal price war. But beneath the surface, hidden technology assets are actively redefining what this company is actually worth. Here's what happened. NIO held a roughly $23 million stake in a Chinese memory chip maker called CXMT. When CXMT went public, the stock didn't just rise. It detonated, surging as much as 530%, and just like that, NIO's $23 million position ballooned to around $132 million, handing the company an unrealized paper gain of over $100 million overnight. And here's the part that should make you sit up. Their in-house chip unit, Genetec, just got formally designated by Morgan Stanley as a, quote, visible call option. Do you understand what that means? Wall Street is now officially shifting NIO's narrative away from being a struggling automaker and toward being an AI silicon platform. That is a completely different valuation universe. Retail traders might have missed this fundamental shift entirely, but Wall Street's algorithmic trading desks, they did not miss it for a second. Institutional algorithms aggressively accumulated shares ahead of this turnaround. SEC filings confirmed that Renaissance Technologies stepped in and purchased roughly 6 million shares, bringing their total position to over 14 million shares. Now think about who this is. This is a quant fund built by mathematicians and physicists, a firm whose flagship models are so good they've become legendary across the entire finance world. And their models told them to buy NIO right at the exact fundamental floor we had charted. Smart money didn't buy at the top out of greed. They stepped in at the bottom, validating the massive disconnect between a sub-$5 share price and the company's true underlying value. So let me ask you this. If the smartest quant fund on earth is loading up down here, what exactly do they see that the panicking crowd doesn't? This institutional backing was immediately put to the ultimate test when a worst-case scenario suddenly flashed red across the delivery charts. In our previous analysis, we issued a clear warning. We said NIO absolutely needed to hit 40,000 deliveries in July. And if they missed that number, the stock could break down all the way to its 52-week low of $3.34. Well, here's the uncomfortable truth. They missed it. July deliveries came in at 35,934 vehicles. That was an 11.5% decline month over month. By every rule in the traditional playbook, this stock should have collapsed. So did it crater to $3? Here's the shocking part. It didn't. Instead, NIO logged its best week in 4 months. Let that sink in. The bad news landed exactly as we feared, and the stock went up anyway. Why? Because that massive CXMT windfall and the immediate wave of analyst upgrades acted as an unbreakable fundamental buffer. The $4.50 floor held rock solid, and the bearish threat we warned about was completely neutralized. This is what a fundamentally supported stock looks like in the wild. And speaking of those analyst upgrades, Wall Street is quietly and very deliberately changing its tune on this company's entire timeline to profitability. The consensus is aggressively upgrading NIO's long-term outlook. Zacks Research just upgraded NIO to a strong buy, raising their future earnings per share estimates and projecting a strict path to full profitability by 2027. Then Goldman Sachs upgraded the stock from neutral all the way to buy, slapping a formal $7 price target on it, which from recent levels implies roughly 40% upside. HSBC joined the party too, lifting NIO to buy and raising their target to $6.80, citing stronger conviction on 2026 volume growth. And as we mentioned, Morgan Stanley is now valuing NIO's AI silicon technology as a distinct premium sitting on top of the base manufacturing business. These are not minor tweaks. These are systemic re-ratings of the company's entire business model happening in real time right in front of us. So with all these upgrades stacking up, the obvious question becomes, what is all of this actually worth for an investor buying in today? If we dig into the real numbers, the valuation gap reveals a minimum of 30% upside from the current stasis cage. With the price sitting under $5, the average Wall Street target now lands between $6.70 and around $7.40, and it gets better. A fundamental discounted cash flow analysis places fair value at $7.31, which means, by that model, this stock is roughly 33% undervalued right now. Morningstar echoes this bullish stance, forecasting that NIO's annual deliveries will double to 670,000 units by 2030. So imagine that for a second. What happens to a stock price for failure when it actually doubles its deliveries instead? Now, while these valuation models look incredibly promising on paper, none of it matters if the real-world manufacturing data doesn't back it up. So let's stress test it. Macro delivery trends completely overshadow the short-term monthly noise. Yes, July missed the 40,000 mark, but that 35,934 delivery figure still represents a massive 71% increase year over year. Read that again. A month everyone called a disappointment was still up 71% from the prior year. Year to date, total vehicles delivered have hit 227,057, which is up 68% from last year and an all-time high for the company. And structurally, their all-new ES8 just reached 130,000 cumulative deliveries in a record 305 days. The operational machine underneath all this drama, it is running flawlessly. So the fundamentals have clearly established an unshakable floor. But it's the technicals that are about to light the match, and this is that hidden metric I promised you earlier. This is the explosive fuel for the coming technical breakout. Right now, there are 128,280,000 shares sold short, making up around 5% of the total float. But the number that actually matters here is the days to cover ratio, which sits at roughly 5.25 days. What does that mean in plain English? It means it would take more than 5 full days of average trading volume for every short seller to buy back and exit their positions. Now, on its own, that's not a guaranteed short squeeze. But think of those 128 million trapped shares as highly combustible fuel sitting in a dry field. All it takes is one positive fundamental spark, and those shorts are forced into a frantic scramble to buy back shares, which drives the price up, which forces even more of them to buy, and so on. That's the fuel. Now let's find the match. Because if you pair those trapped short sellers with the current state of the options market, you get a highly coiled mechanism just waiting for a single trigger. The options chain is tightly coiled beneath a very distinct ignition switch. We have a heavy put wall firmly established at $4.50, acting as our floor. And we have massive call open interest stacked between $5 and $5.50, acting as compression above the price. So the stock is being squeezed into a narrowing wedge. And the ignition switch? It's the 50-day moving average, sitting right between $5.09 and $5.16. Here is the key. The moment NIO breaks and closes above that $5.16 resistance, it forces the options market and those trapped short sellers into a forced buying feedback loop. That is the exact mechanism that could rapidly bridge the gap and send this stock climbing directly toward Wall Street's $7 targets. One clean daily close, that's the trigger everyone's watching for. Now, a violent squeeze might rocket this stock to $7 in a hurry, but here's a fair question. What actually keeps it there for the long haul? NIO's upcoming strategic catalysts are what guarantee a robust multi-year runway for expansion. First, their battery swap energy network is executing an aggressive, backloaded rollout, with hundreds of new fifth-generation swap stations opening in the fourth quarter alone, turning their charging infrastructure into a genuine utility business. Second, their sub-brands, OnVO and Firefly, are rapidly capturing the mass market. In July alone, OnVO delivered over 10,000 vehicles, and Firefly added nearly 6,000 more, meaning these newer brands are now a huge and growing chunk of total volume. And third, Genetec offers diversified technology revenue, expanding NIO well beyond vehicle sales into chip licensing, robotics, and autonomous logistics. This is no longer a one-trick company. It's building 3 different engines of growth at once. Which leaves us with the single most important question for your portfolio today. How exactly do you execute a setup like this? Here is the actionable playbook for this risk-to-reward opportunity. If you're a short-term trader, the approach is to buy or hold, accumulating near that $4.50 structural floor where the institutions have drawn their line. Your trigger is simple. Strictly monitor the 50-day moving average between $5.09 and $5.16 and wait for a clean daily close above that line before you ride the options and short squeeze breakout. Don't jump the gun. Let the trigger confirm itself. Now, if you're a long-term investor, the thesis is much simpler. This looks like a strong buy accumulation zone. You're buying shares at multi-year lows and positioning yourself for the transition from a cash-burning EV manufacturer into a diversified AI and technology utility. And you hold through that Zacks and Morningstar projected path to full profitability by 2027, letting the story fully play out. 2 different time horizons, one very compelling setup. And that brings us to the final verdict on NIO's explosive setup. What we are witnessing right now is a rare and near-perfect convergence of fundamental value and technical pressure, all firing at the same moment. Hidden tech assets have established an unshakable floor beneath the price. Wall Street consensus is aggressively pivoting, stacking up multi-year profit targets one after another. And 128 million short shares sit trapped right beneath a technical trigger, just waiting for a spark. Put it all together, and the conclusion is hard to ignore. NIO appears primed for a potentially violent breakout toward that $7 consensus target. At current sub-$5 levels, the risk-to-reward ratio looks overwhelmingly favorable. Now, before we wrap up, I need to be crystal clear with you about something important. Everything I've shared in this video is for educational and informational purposes only. I am not a licensed financial advisor, and this is absolutely not personalized financial advice. Every single number, price target, and projection I mentioned comes from public sources and analyst opinions that can change at any moment, and past performance never guarantees future results. Investing in stocks, especially volatile ones like NIO, carries real risk, including the risk of losing money. So please, always do your own research and consider speaking with a qualified financial professional before you make any investment decision. Your money, your responsibility. With all of that said, I want to hear from you. Here's my question for the comments. If NIO breaks above that $5.16 trigger next week, are you buying the breakout or are you waiting for a pullback to the $4.50 floor first? Drop your answer below because I read every single one and I genuinely want to know how you're playing this. If this deep dive brought you value, smash that like button. It truly helps more than you know. And subscribe so you don't miss the next update when we grade these exact predictions all over again. Thanks so much for watching, and I'll see you in the next